Today we're digging into the Grover Jewells IPO. Now on the surface, it looks like a glittering opportunity. But if you look just a little closer, you might start to see some potential flaws. So let's get into it.
So let me ask you something. A company's revenue and profits, they just suddenly explode right before their IPO. Is that a sign of an incredible can't-miss opportunity, or is it a massive red flag? Well, that is the central question we're tackling today with Grover Jewells.
All right, so first things first, let's get to know the business. Who exactly is Grover Jewells, and what do they do?
Okay, so Grover Jewells itself is pretty new. They were only incorporated back in 2021. But, and this is important, the promoters, the people running the show, they've been in the jewelry game since 2010, so they've got experience. They're based in Delhi, and you can find their showrooms right in the heart of the action in Karol, Bagh, and Chandni, Chowk.
Now, this is where it starts to get really interesting. Where does their money actually come from? You'd probably guess they sell jewelry to people like you and me, right? Well, that's less than 1% of their business. The vast majority is B2B, business to business. They sell to wholesalers and other retailers. And that's a really key detail to remember, because it means their entire success depends on a pretty small group of big clients.
And if you think their customer base is focused, wait till you see what they sell. I mean, look at this. A whopping 97% of their revenue, it comes from just one single product. Gold chains. That's it. This kind of specialization, it's a double-edged sword, right? On one hand, it can make them super efficient. On the other, it can make them really vulnerable.
All right, so with that in mind, let's look at the bull case. Why are some investors getting so excited about this IPO? Well, it all boils down to some pretty jaw-dropping numbers. And here it is. This is exactly why people are paying attention. Just look at this revenue surge. They went from 258 crore to 461 crore in 1 year. And get this, in just the first 7 months of this financial year, they've already surpassed all of last year, hitting 473 crore. I mean, that's the definition of hockey stick growth. It's exactly the kind of thing that gets IPO investors buzzing. And if you thought the revenue was impressive, check out the profits. It's an even more dramatic story. We're talking about going from under 3 crore to over 7.5 crore. And now they've already pocketed 10 crore in just 7 months. You see what's happening? It's not just growing, it's accelerating. And it's happening right before they ask the public for money. So, with numbers like these, it's no surprise that some analysts are getting pretty bullish. This quote here from Daily Stock sums it up nicely. They're basically saying, apply for listing gains. They think this thing could pop 30, maybe even 40% on day one.
Okay, but as we know, for every bull case, there's a bear case. Not everyone is buying this glittering growth story. So let's flip the coin and dig into the stuff that has the skeptics raising their eyebrows.
So, how did they pay for all this incredible growth? Well, there's a catch. And this chart tells the whole story. The answer is debt. Their borrowing is absolutely ballooned, jumping from 9 crore to over 28 crore in just a few months. That's a huge red flag for skeptics. And it begs the question, is this real sustainable growth, or is it all just fueled by borrowed cash?
And that's not the only concern. Analysts are pointing to a whole list of red flags. First, the timing of that profit spike. It's a little convenient, right before an IPO. Second, their top 10 clients make up almost 40% of their revenue. Third, their margins are razor thin. On top of that, they've got negative cash flow. And the promoters themselves are selling off part of their stake. You know, any one of these would be a worry, but when you stack them all up, it starts to look like a pretty risky picture.
And if that wasn't enough, there's another thing. People are looking at the lead manager, that's the investment bank handling the IPO, and their track record, well, it's not great. As this analyst points out, their recent IPOs haven't been very convincing. That just adds one more layer of doubt to the whole thing. Okay, so we've laid out the bull case and the bear case. Let's get down to the brass tacks, the IPO details. If you're thinking about putting money in, here's what you need to know. First up, the timeline. You've got to be quick on this one. The IPO opens on February 4th and closes on the 6th, so that's a really tight window. And the listing itself is happening on February 11th on the NSE SME platform. That's the stock exchanges board for smaller companies. As for the price, they've set a band between 83 and 88 rupees a share. Now, if you've ever applied for an IPO, you know the drill. Most people will apply at the higher price, 88 rupees, to give themselves the best shot at getting an allotment. Okay, here's a really important detail. Remember I said it's an SME IPO? That changes things. You can't just buy a few shares. You have to buy in what's called a lot. And for this one,
The minimum lot size is 1,600 shares. Do the math. That means your minimum ticket to get in is well over a lakh rupees. So it's a much bigger commitment than your standard IPO.
So what's the goal here? All told, the company's looking to raise about 34 crore rupees, and they're saying most of that cash is going right back into the business as working capital, basically to fund their day-to-day operations and hopefully keep growing.
All right, we've seen the good, the bad, and the ugly. So what's the final call from the experts? Where do they land? Well, surprise, surprise, they're completely divided.
You basically have two camps, and they could not be further apart. On one side, you've got the optimists. They see that incredible growth, they think the price is reasonable, and they say go for it, mainly for a quick profit on listing day. But on the other side, you've got the skeptics, and they are screaming avoid. They point to all those red flags he talked about, the suspicious growth, the huge debt, the lead manager's poor track record. For them, the risk just isn't worth it.
So where does that leave us? It comes right back to our original question. You've got soaring growth on one hand and a mountain of red flags on the other. Is the potential reward with Grover Jewells worth the very obvious risk? That's the question every potential investor has to answer for themselves.